Here's another collector's item, lower of cost or market. What could happen is you have a seasonal product where the value of that, the cost of that item or the market value of that item fluctuates during the year. Like take natural gas. Natural gas is expensive in the winter and it's cheap in the summer. So what are you going to do with lower of cost to market with that over the summer? Because the market value has gone down, but you expect to be able to sell it at a full price later on. So let's talk about it. So let's say at the beginning of the year, Peerless has 10,000 units on sale, on hand, with a FIFO cost of $10 in each. They make no additional purchases during the year, and sales and market value at the end of the year is as follows. So you can see here is they paid $10 a unit. And at the end of quarter one, it's only worth 7. At the end of quarter 2, it's worth 6. End of quarter 3, it's worth 7 again. And by the end of quarter 4, the price is recovered to $11. So if Peerless considers these reductions to be permanent, then they recognize the reductions in the quarters in which they occur. If they consider these reductions to be temporary with recovery by year end, then no recognition is required. So if the reductions are permanent, it's a write-down. But if you consider these reductions to be temporary and you expect that the price is going to recover by year end, then you don't need to do anything at all. You can, well, we'll go into what you're going to do, but it doesn't need to be written down permanently. So here's an example of how to look at this. And again, this is all out of the book. I think almost all the stuff is out of the book anyway, but I'm just not using PowerPoints. I'm not doing Excel for this particular chapter. It's not the kind of calculation intensive stuff that we usually have. So we start off with 10,000 units at $10 each for a total inventory value of $100,000. Anyway, we sell 2,000 units, so it comes off the books at $10 with so that's worth $20,000. But like my son would say, wah, 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 the value of the inventory has dropped to $7. Wah, wah, wah. So it's $7, we got to write it down. So we're going to write down the remaining 8,000 units by $3 as a $24,000 write down. And now I've got 8,000 units at $7 each, $56,000. I sell 2,000 more units and they cost $7. That's $14,000. And again, the value of the inventory has gone down, this time to $6. Whoa, whoa, whoa. So $6,000 times 1 is a $6,000 write down. 6,000 at the end of the quarter, I have 6,000 units left. They're only worth $6 under lower of cost to market, $36,000. And I'm glossing over a lot of the details of how you do lower of cost to market. Here's the fun part. Normally, when you do lower of cost to market adjustments and you write your inventory down, that's it. Game over, it's written down. If you expect it to recover when you do the write down, and that is recover by the end of the year, then when the value goes back up during the year, you can take it back up. So here, by quarter 3, inventory sold is 2,000 at a unit price of $6 a piece. Total inventory value is $36,000. But now the stock price is, the market value has increased to $7 a share. So you can write it up. There we go. You can write it up. So $1, you have 4,000 units left at $1, and you can actually write up the inventory by $4,000. So you've got now 4,000 units at $7 a piece for total inventory at $28,000 because you've been able to write it up. You sell another 2,000 units for $7 because that's now the book value. The book value has gone up. And you got $14,000 comes out of inventory. And now, guess what? The market value has increased to $11 a unit. Well, what do you do now? Because we only paid $10 a unit. So what you can do here is you can write it up to $10 a unit. I know it's worth 11 now, but you only paid $10, and therefore you can only write it up to $10 a unit. Here. So another way to look at this is we've got these write-downs to market. On the interim statements, what you're going to have is you have a combination of the cost assigned to the cost of goods sold, plus you have the write-down. So both of these are going to hit the income statement. But here, when the value starts going up, you not only have 2,000 units at $6, but as the value starts going back up again, you can take these back into income by offsetting them against cost of goods sold. And same thing in quarter four. You have 2,000 units at $7, plus you had write-ups of 2,000 times 3. These would offset each other. 14,000 minus the $6,000 in write-up recoveries would give you only $8,000 in cost of goods sold in the fourth quarter. So this would be the effect of the inventory in each of these quarters. It's a combination of the cost of the inventory that you sold, plus or minus the write-ups and the write-downs. But you're allowed to, I shouldn't really call them write-ups, you're allowed to recover a write-down up until your cost, but not above it. All of the costs and expenses are charged the interim period wherever they occurred. So this follows logic. If something is spread out over a period of time, then it's going to be spread out over the interim periods of time. And if it occurred at a specific point in time, then it's going to be recorded in that specific point of time. Now let's talk about income taxes. And there's a number of steps you got to take here. It's the concern here is that you want to allocate your income tax expense over the interim periods, over the quarters. The problem is that income tax expense varies based on a progressive tax rate, and you're not quite sure how much money you're going to earn all year long. There's also an additional problem that tax rates sometimes change. And so at the beginning of the year, you don't necessarily know what tax rate you're going to be paying for the full year, and yet you're still going to be expected to estimate your tax expense for the first period. So the first thing that you would do is determine, and by the way, you got to follow these steps and don't follow shortcuts. The first step is determine the effective annual tax rate to be used in computing the interim income tax provision. And it's very important to note here, this is the annual tax rate. The estimated annual tax rate includes everything that you think is going to happen for the full year. So any anticipated tax credits, state income taxes, foreign income taxes, capital gains taxes, whatever you think is going to happen during the year. And then that you use that to estimate what your total tax rate is. And this is not a marginal tax rate, it's an effective annual average tax rate. And then each interim period, when you go and do this analysis, you have to go through this exercise again and do all this stuff to update the estimated annual tax rate. And you're going to use that to determine what the interim tax provision is and subtract any previously recorded taxes. And you would not include unusual or infrequent events, discontinued operations, and so on. And what makes this even more interesting is how you're going to handle deferred taxes. I had this sound, but I totally got the timing off. Anyway, what makes this complicated is deferred taxes. So permanent and non-temporary differences are not included in determining the amount of taxable differences. You only have to focus on the temporary differences. So permanent differences here are going to just be set aside, and you're not going to have to worry about them for interim calculating an interim tax position, interim tax provision. So examples of permanent differences would be life insurance premiums, dividends received deduction, interest income received on state or local government bonds, certain types of fines, and so on. What we have to focus on, though, is we will have to focus on temporary differences. And these would be differences between recognition of a transaction for book versus tax income result in deferred taxes. These result in deferred taxes. So, and we do have to record deferred taxes in an interim period. So some temporary differences could result from rent collected in advance, estimated expenses and losses, accelerated depreciation on a tax return when you use straight line in your income statement, which is there's always a difference because of accelerated depreciation of makers, and write-downs to lower of cost to market. We were talking about that before. Interestingly enough, those revaluations of inventory are temporary differences for tax purposes. So let's take the first quarter. This is from page 706 of the book, and it's also provided at the top of the page. It's also in 707. Let's say that we have a loss in the first quarter, which is obviously year to date, and the estimated effective annual tax rate at that time is 24%. So then what you would have is you would have here a tax benefit of $40,000 year to date times the effective rate of $9,600. You would have a tax benefit. So far nothing has been recorded, so you would report in this period a $9,600 tax benefit. It's negative. When you have a loss, you have a tax benefit. Now for the second quarter. In the second quarter, which I misspelled here, we had $20,000 in income. So year-to-date amount would be $20,000 plus the $40,000 we had in the first quarter, or a $20,000 loss. So that would be, and our estimated effective annual tax rate is 34%. So we would expect a full tax benefit now of $6,800. But we previously recorded a $9,600 tax benefit. So now I would have to cut down that tax benefit and record a $2,800 negative benefit, i.e. a tax provision of $2,800 in the second quarter. In the third quarter, I'm profitable. I've got $80,000 in income. Previously, in the first quarter, so I have $80,000 in income, but so far, I've recorded to date $20,000 in losses. So that would mean my year-to-date income was $60,000. Minus 40 plus 20 plus 80 equals 60,000. And my estimated effective annual tax rate is still 34%. So the tax on that for the entire year, for my tax on that for the first 3 quarters would total $20,400. Now, I've recorded so far a $9,600 tax benefit plus a $2,800 tax provision. So I have $6,800 tax benefit recorded, and therefore I would need to record a tax provision offsetting the benefit and taking the additional tax provision in this period of $27,200. Now the book here goes into a thing with the whole net operating loss, and let's not worry too much about that, how you would handle a situation where you could reverse a net operating loss carry forward. Let's just not go there, okay? So we have in fourth quarter $162,000, and we previously had income of $60,000. So our total income year to date is $222,000. So times the estimated tax rate of 27.9%. And again, they went into a certain calculation to show how you would do a net operating loss carry forward with this, and that's how they got this weird tax rate of 27.9%. Let's never mind that. So that would mean that total taxes for the year should be $61,938. So far, I've recorded tax provision of $20,400. That would be $9,600 in the first quarter as a benefit, $2,800 expense in the second, $27,200 as an expense in the third. So I previously recorded $20,400 in taxes in previous periods. I've now got to record $41,538, and there's a little down rounding difference there. If you look in the book, they got $41,600 because of this weird thing. That's what would be reported in the fourth period. So you can see here that the total of the income over the 4 periods is equal to 222, which just happens to be the same as that. That's the year to date. And you would have a similar total here with reported in period. If I report all of these in period, they add up to what my total tax should be for the year, $61,938. So it's kind of a catch-up basis. In other words, if you don't record something in the first period and circumstances change in the second, then the entire effect of the change would be recorded in the second quarter. A little trivia here, the most recent Tax Act in December 2017, the act was passed in December 2017, and everyone's tax rates were changing. So what happened was that the effects of these rate changes were all recorded in the fourth period. And if you look at companies' tax provisions during 2017, you'll see that the fourth period tax provisions are like way, way off from everything else the company did because they need to record the entire effect of it in the fourth period. Major non-operating items, infrequently occurring items, contingent items, things like that, usually happen all at once, and so they would need to be recorded in the period when they happen. Same thing with discontinued operations. They're going to be recorded in the interim period where they occur. If you're a disposal of a component of an entity, the materiality test here for discontinued operations is based on operating income of the interim period when it was reported. And contingencies, the rules for contingent liabilities are the same as they are for year end. So if you need to estimate what liabilities need to be recorded based on what you can reasonably estimate and is more likely than not to happen, and if that's can be estimated and is more likely than not to happen at the end of an interim period, then you need to record it during an interim period and adjust it continuously as you see fit. That's ASC 450. Accounting changes require retrospective application. In other words, what you need to do is you need to go back to the beginning of the period. And these would be the direct effects of the changes, including the tax effects. You'd focus on the balance sheet, get the balance sheet numbers right, and then all of the income statement effects all the income statement effects are recorded as the change in accounting principle at the bottom of the income statement. A change from an accounting principle not generally accepted to generally accepted is considered to be a correction of an error. It requires restatement of everything, including all interim periods. So you'd have a change in an accounting estimate when you have new information during a quarter. These, you don't go back to previous quarters and change them. They're done on a prospective basis only, and you record them in the current period and ongoing as you see fit. If you have a change in a reporting entity, that's done retrospectively to all prior periods so that your financial statements are presented in a consistent way. So for example, a decision to consolidate should be made at the beginning of the first period, should take effect at the beginning of the first period that you're presenting so that all of the financial statements are consistent. Of course, if you acquire an entity on a certain date, then you would start, and it's consolidatable, then you would start consolidating as of that date. IFRS in these cases is very, very similar to GAAP reporting in the US.